Tuesday, the IRS once again making adjustments to the federal income tax brackets. This happens because of cost of living adjustments. But what does it mean for you? Financial expert Marshall Clay with the Welsh Group joins us to try to break down what you need to know for next tax season. Good to see you this morning.
Good to see you.
First of all, let's start with those standard deductions. How will those change?
Right. So essentially, the standard deduction is a lump sum fixed dollar amount that taxpayers can deduct against their income each year. And it's really important to understand these because if you have a certain level of expense, you can get launched into what's called itemized deductions. And that typically involves if you have large amounts of state and local taxes, you have a lot of home mortgage interest, or you give a lot of money to charity, or you have a lot of medical bills. But most people fall in the standard deduction category. And so the reason why the standard deduction is so important is I see a lot of people making capital allocation decisions as it pertains to, say, like housing, for example. They say, well, look, I can handle an 8% interest rate on my house because I'm able to deduct that interest against my taxes. Well, that may not be true if you fall into the standard deduction category. So understand these limits. So as these limits grow, so in 2024, you're going from a $27,700 standard deduction if you're a couple married filing jointly to a $29,200 deduction. So that's a $1,500 a year increase year over year. So understanding those limits is very important when you're thinking about how to allocate your capital. And then the other thing too that these provisions affect is your company retirement plans and the IRAs.
What you can contribute.
That's correct. Yeah, on an annual basis. So if you're as an individual, last year you could contribute $22,500. That's gone up to $23,000. So essentially these are dollar amounts that the government is incentivizing you, or limits that the government is incentivizing you to reach. Now, I think it's important to understand these so you can start budgeting now. So you can try to make room in your budget to maximize out these elective deferral amounts on your 401k. Right. Now for an IRA, it's only going up $500. So last year it was $6,500 in 2023. It's going up to $7,000 in 2024. Obviously, there's some catch-up provisions both for the 401k or the company retirement and the IRA if you're over 50. And that's
those amounts haven't changed though. Looks like.
Yeah, those amounts have not changed. So it's still $7,500 for the catch-up for 401ks and $1,000 for the IRA. So I mean, these are incentives that the government's telling you, like, please do this. So the taxpayer should take heed of this and really try to use these as goals for your financial planning.
Yeah, because they don't want people in debt; they want people to save.
Absolutely,
that helps us all, no doubt.
Absolutely.
Marshall Clay with the Welsh Group, we do appreciate it.
You're welcome.
All right, still ahead. This is something you might need. It's a new product that promises to put out